Welcome, everyone. This is a specialized exploration brought to you by AccumulationPro, and it's really designed to significantly boost your understanding of how to navigate the trading landscape. It can be tricky.
It definitely can.
Today, we're taking a real deep dive into something crucial, something that, frankly, a lot of traders find perplexing: price risk.
Right. And we need to forget that really simplistic idea that, high price equals high risk. It's just not that straightforward.
Exactly. We're going to unpack a much more nuanced approach, strategic one that's ultimately, hopefully, more effective in thinking about what price is really telling us.
Think about those times, you felt that hesitation looking at a stock that's like right near its peak.
Oh, yeah.
That assumption, that gut feeling that it's just got to fall. Well, it's natural. Mm-hmm. And conversely, you see a stock that's really plummeted in price.
The bargain hunter comes out.
Yeah, exactly. That hope for a quick rebound, it's just as understandable. But these instincts, they're not inherently wrong, but they often lack that vital context, don't they? The kind that turns a gut feeling into, an informed decision.
So our mission today, representing AccumulationPro, is to equip you with, let's say, a more robust framework, a way to interpret price risk with a much sharper lens, moving way beyond just those surface-level glances. Mm-hmm. We'll explore how understanding a security's price, not in isolation, but directly in relation to its recent history, its highs and lows over the past year, and crucially, how that connects with key signals from the wider market. Well, we think this understanding is incredibly powerful.
It really is. Powerful for protecting your capital, for sure, but also for identifying those genuinely promising opportunities that maybe others might just glance over.
And we're going to delve into this concept of distribution phases.
Yeah, these often pop up near price tops. And learning to recognize the subtle signs that can be so instrumental in helping you sidestep potential downturns, protect your investments.
And on the flip side?
Well, on the flip side, we'll look at how a seemingly high price, if it's supported by real demonstrable market strength, can actually be a huge signal, maybe pointing to the very start of a significant, sustained upward trend.
So consider this deep dive your shortcut, maybe, to a much more informed perspective on price action. We really want to help move you away from relying just on those instincts, those often emotional reactions.
Yeah, towards a more data-driven, evidence-based understanding of what the market's truly saying.
Exactly.
And look, if you're finding this analysis valuable and you want more of these kinds of detailed explorations, designed to give you an edge, please just take a moment. Like this, share it with others who might benefit, and definitely subscribe so you don't miss our future deep dives.
Yeah, your support really does help us bring this kind of nuanced perspective to more people. It's invaluable.
Absolutely.
Okay, let's really dig in here then. At AccumulationPro, we genuinely believe the first crucial step is to, redefine how we fundamentally think about price risk.
Yeah, we have to move away from just looking at the absolute number on the screen, the price level itself.
Right, and instead adopt a much more contextual understanding.
A very common and frankly kind of basic understanding of price risk is just, the chance the stock's price will go down.
Seems simple enough.
It does, but it's not technically wrong, but it lacks any real depth, doesn't it? Any practical use for making smart trading decisions.
What's the better way?
A far more refined and I think much more useful perspective involves carefully looking at a stock's current price relative to its annual trading range.
You mean the highest and lowest points over the last year?
Exactly. The highest price it's hit, the lowest it's touched over the past 52 weeks. And what's really fascinating here is how just this simple shift, looking at the relative position within that range, can fundamentally change how you assess the potential risk and rewards.
Okay, picture this scenario. You're looking at a stock, right? Mm-hmm. And you see it's trading quite close to the very top of that yearly range. Mm-hmm. Your immediate thought might just be, whoa, that's expensive. It's probably going to pull back soon.
That's the common reaction. Yeah.
But let's consider another angle. What if that high price is actually the result of a significant breakout?
Okay.
Maybe it just broke free from a long period where it was just stuck, consolidating in a tight range for weeks, maybe even months.
Right, building a base.
And what if that breakout comes with a big surge in trading volume, like real conviction behind the move? And maybe various technical indicators are suggesting strong buying interest, perhaps from those sophisticated investors, the smart money we talk about.
Okay, yeah.
In that situation, a seemingly high price could actually be signaling the very start of a powerful, sustained new uptrend. It's not just about the number, is it? It's the story behind it.
Precisely. And if we connect that thought, A breakout supported by much higher volume, plus positive signs from those smart money indicators, that suggests a real conviction in the market. Meaning, large, well-informed investors are putting significant capital to work. They're signaling their belief in that asset's future appreciation. This isn't likely just, speculative short-term stuff. It's often based on deep analysis that company's fundamentals, its competitive edge, its place in the economy.
That kind of buying provides a stronger foundation then.
A much stronger foundation for continued upward movement, yes.
Okay, now let's flip the coin. Imagine a different stock.
Yeah.
This one's trading very near its annual low.
Right, the opposite end of the spectrum.
Your first reaction might be, bargain, undervalued opportunity, time to buy.
Tempting, very tempting.
What if there's just no real evidence of accumulation? What if you don't see any convincing signs that buying pressure is increasing? No indication that those informed investors are stepping in. In that case, the low price might be completely justified by, underlying weaknesses. And buying in could be like trying to catch a falling knife. And potentially very painful experience.
Ouch.
It feels counterintuitive, doesn't it? A low price should feel less risky, but the context is just missing from that initial reaction.
It absolutely does feel counterintuitive, and that's exactly why understanding this more nuanced view of price risk is so critical. It raises a really important question. Why is this stock at its annual low?
Good question.
Is it just some temporary bad news, market headwinds that might blow over? Yeah. Or are there more fundamental, long-lasting problems with the company or its industry?
And without seeing those signs of accumulation.
Without seeing those signs, that low price is often just a clear reflection of falling investor confidence and potentially further price drops ahead. You might see it as a deep discount, but realistically, it could be what we call a value trap.
Looks cheap, but keeps getting cheaper.
Exactly. Looks cheap on the surface, but just keeps losing value.
So the crucial takeaway here, and this is really a cornerstone of AccumulationPro's philosophy, is you must move beyond just slapping a high or low label on a price in isolation. Instead, the key questions you need to constantly ask are, is this specific price level genuinely supported by the underlying market structure? Are there clear signs of accumulation happening, suggesting knowledgeable, capitalized investors are building positions?
Right.
And maybe most importantly, is the broader market environment participating? Is it confirming this specific price movement? It's like being a market detective, isn't it?
Yeah.
Looking for those corroborating clues.
That's a great analogy. You're piecing together the evidence to understand the real story behind the price.
So consider a stock hitting a new 12-month high.
Okay.
Now, if this breakout happens after a long sideways trading period, that consolidation phase.
Right, the base building.
And it's accompanied by a significant jump in trading volume, plus maybe a pattern of consistently higher lows leading up to it, and positive money flow indicator.
You're listing all the good signs there.
Well, all those things together can be very compelling signs, right? Signs of accumulation and the potential for more upward momentum.
Absolutely. What's really significant there is the confluence of those signals, that long sideways range. It often means buyers and sellers were kind of balanced.
A stalemate.
Pretty much. Then the decisive breakout, especially with more volume, shows a clear shift. Buyers are now firmly in control. And those higher lows, they suggest growing underlying demand. Positive money flow just reinforces that idea serious capital is moving in.
It might seem counterintuitive maybe at first glance, but buying a stock that's trading at its annual high isn't always a high-risk move.
Not always, no.
In fact, if a stock has built up a really solid price base over several months, showing stability, consistent buying interest, and then it breaks out above its old high with substantial volume, this could very well be the start of a brand new, powerful, bullish phase.
Right, not the end of an old one.
Not the final gasp of an old trend. So in certain carefully analyzed situations, the highest prices could actually represent some of the safest, most opportune entry points.
Under the right conditions, absolutely. If a stock has gone through healthy consolidation, built that strong foundation of support, a breakout above the prior high, especially validated by strong buying interest volume, smart money indicators, that can signal the beginning of a major uptrend.
So the risk might be hesitating.
In that specific scenario, yeah, the real risk might actually be hesitating and missing that initial, often most powerful part of the move. But, and this is a crucial distinction, you absolutely have to differentiate this kind of breakout from a stock that's just shot up vertically.
Like a rocket with no pauses.
Exactly. No meaningful consolidation. That kind of parabolic rise is generally a much, much riskier entry point. It just lacks that solid base of support underneath it.
Right. Conversely, and this is a tough lesson many learn, that temptation to buy a stock just because its price looks inexpensive, that can be loaded with risk.
Definitely.
If the stock is clearly trending downwards and there are just no discernible signals of accumulation, no sign that buying pressure is starting to build, you could very easily be stepping into a situation with potential for significant further losses. It's often compared to trying to catch that falling bowling ball, right?
That's a very vivid and accurate analogy. The outcome is rarely good.
So, without concrete proof that the selling is letting up, and buyers are finally stepping in to create some support.
Just buying a stock in a clear downtrend because the price has fallen a lot, that's a perilous strategy. You're essentially betting against the prevailing trend.
And without evidence, the trend's turning.
The odds are often stacked against you.
Okay, let's walk through a practical scenario just to really nail this down. Imagine you're evaluating two different stocks right now.
Okay.
Both seem to show bullish chart patterns. Both have relatively strong trading volume. So far, so good.
Sounds promising.
But here's the key difference.
Wow.
One stock is currently trading way up near the top end of its annual price range,
Okay, near the highs.
while the other one is trading much closer to the lower or maybe the middle part of its range. So surface level, they might look a bit similar, but their price context within the year is drastically different.
Very different context, yes. Now let's assume all other factors, those bullish patterns, the strong volume, are roughly equal between the two.
Right, all else being equal.
A stock trading in the lower or middle part of its annual range might actually present a more prudent, maybe more strategically advantageous opportunity for several key reasons.
Which is?
Well, firstly, just by its position, it inherently has more potential upside before it even gets back to its previous annual high. Think about that asymmetry, potentially a much longer runway for gains before hitting that prior resistance where selling might pick up.
Makes sense. More room to run. What else?
Secondly, if this stock has been consolidating down in that lower range for a while, the level where you'd likely place your stop loss order.
That crucial exit point for limiting losses.
Exactly. That stop loss would typically be closer to your entry point. Why? Because there's usually a lower price volatility within that consolidation band.
Okay, tighter stop. What's the benefit?
Well, a tighter stop loss allows for the possibility of taking a slightly larger position size while still sticking to sound, disciplined risk management. It's about using your capital efficiently while keeping a tight lid on your potential downside.
Better risk management through tighter stops.
Yeah.
Got it.
Precisely. Lower volatility and consolidation allows for much tighter risk control. Your stop loss, absolutely essential for capital protection, can be closer, limiting potential losses if the trade goes against you. That improved risk-reward ratio, potential profit versus potential loss, can be a huge advantage long-term.
And there was a third reason.
Yes, consider this. In times of broad market volatility, unexpected panic selling, a position established in a lower price range might actually be less susceptible to getting hammered compared to one taken right near an annual high.
Like it's already weathered some storms.
Kind of. This difference in price context can really influence your overall trading profitability and that critical balance between potential reward and the inherent risk you're taking. It's like having a bit more of a built-in safety buffer, maybe.
Interesting. So a stock already down in the lower part of its range might have already absorbed significant selling, making it potentially more resilient during wider market dips.
It could prove more resilient, yes, compared to a stock that just surged to a new high and might be much more vulnerable to profit-taking or just a sudden shift in market mood.
So by selectively focusing your attention and your capital on stocks showing those clear accumulation signals at smart money buying, while they are trading in the lower half of their annual range, you can strategically position yourself to potentially sidestep those often dangerous market distribution phases.
Right, those periods usually near market peaks where the big institutions might be quietly selling off their large positions.
This more discerning approach then encourages a more careful selection, prioritizing higher quality setups.
Exactly. It prioritizes setups with potentially higher quality and a more favorable risk-reward profile.
So, focusing on stocks in lower ranges, showing accumulation, you're essentially trying to align with the big players buying.
Rather than accidentally getting caught in their selling during a distribution phase.
Correct. Distribution phases are often characterized by those sophisticated investors who got in lower, starting to unload their shares, often while the overall market mood still seems pretty bullish on the surface.
So consequently, by taking this more selective path, you can effectively reduce your overall market exposure.
Yes, which in turn can be a big help in mitigating drawdowns in your trading capital when the market gets weak.
And it helps preserve capital, right? Keeping more funds ready for when those really compelling high probability trades finally show up.
Precisely. It's a defensive strategy that also allows you to be more strategically aggressive when the truly great opportunities align with your criteria.
You're preserving capital by being more selective, avoiding potentially overstretched stocks at the high end without strong confirmation, which puts you in a much better position to capitalize when those higher quality opportunities do arise, when your specific criteria for accumulation and price context are met. It's a more patient, strategic, and ultimately, I think, more sustainable approach.
Okay, let's switch gears slightly. What if you do identify what seems like a genuinely compelling opportunity in a stock that is breaking out to new all-time highs?
Yeah.
And your gut is just screaming that it feels risky.
Yeah, that happens. The fear of buying the top.
What key conditions or confirming factors can you look for to boost your confidence, to reduce the chances of getting caught in a false breakout, a head fake?
Okay, several things. First and foremost, pay very close attention to the trading volume accompanying that upward price move.
Volume again.
Always volume. A genuine, sustainable breakout is very often marked by a noticeable, significant expansion in volume. That indicates strong conviction, broad participation behind the move. Volume is the fuel, right?
It's the fuel that powers the price move, yeah.
Yeah.
Significant increase suggests lots of people are back in the move.
Exactly. Suggests genuine buying interest, reducing the likelihood it's just a short-lived fake-out driven by a few players.
Okay, volume's number one. What's second?
Second, examine those accumulation indicators we've mentioned. These are specific tools designed to give you clues about whether sophisticated, large-scale investors, the smart money, are actively, consistently buying.
Like getting a peek at their actions.
Sort of. Strong positive readings in these indicators can lend significant credibility to the breakout's validity and potential staying power. It's like getting confirmation from those who often know more and have more skin in the game.
So it suggests informed, strategic buying, not just speculative hype.
That's the idea. It provides a greater level of confidence in the underlying strength and potential longevity of the move.
All right, volume accumulation indicators. What's third?
Third, you absolutely must consider the broader market context. Are the key market indexes, the S&P 500, the NASDAQ, whatever is relevant, also showing strength? Are they confirming the upward move in your specific stock?
Is the tide lifting all boats, essentially?
Yeah, exactly. And finally, related to that, look at the overall sentiment. Is it bullish across a wider range of stocks? If you see many stocks displaying similar bullish characteristics, it strongly suggests a broader market trend is supporting your individual breakout. The market kind of has your back, so to speak.
So a breakout is much more likely to be real and sustainable if the overall market is strong and lots of other stocks are also moving up.
Far more likely, yes. It indicates a more significant underlying trend is at play, providing a supportive environment for that individual stock's momentum.
Conversely then, if you're eyeing a breakout, but you notice lots of other stocks look bearish, or the main market indexes look weak or are trending down,
then exercise significant caution. Huge red flag.
why is that such a red flag?
That kind of divergence could be a warning sign. It might be an isolated move in just that one stock, potentially a false breakout, maybe even fueled by distribution where some big players are cleverly selling into the temporary excitement of that new high.
Like swimming upstream against a strong current.
Precisely. A stock breaking out while the broader market is weak, it suggests the move isn't supported by overall strength and could very well be a symptom of distribution. Larger players might be using that brief enthusiasm to unload their shares.
Okay, so how can we get a more comprehensive, reliable understanding of a breakout's strength and sustainability? What tools help?
It's highly beneficial to use tools like market breadth indicators.
What do those tell us?
They give you valuable insight into the market's overall health. They reveal the extent to which a market move up or down is being widely participated in by a large number of individual stocks. Is the rally broad-based or just a few leaders carrying the load?
Gotcha. Breadth gives the participation level. What else?
Index confirmation, as we touched on, checking if key indexes align with your trade direction, that's crucial. And also, using multi-time frame analysis can offer significant advantages.
Looking at different chart periods, like daily and weekly.
Exactly. By comparing price charts of the same stock on different time frames, say daily and weekly, you can spot more consistent, robust trends. You gain stronger confirmation for your signal. More layers of confirmation from different perspectives generally means more confidence, wouldn't you agree?
Absolutely. Breadth shows broad participation. Index confirmation aligns with the majors. Multi-time frame confirms the trend across different views. It builds a stronger case.
A much stronger case.
Okay, so to wrap this up, let's recap some crucial principles for managing price risk effectively. These are really core to Accumulation Pro's risk management philosophy. First
and foremost, always consider the complete context surrounding any trading signal or potential opportunity you spot. Never, ever make decisions based only on the absolute price level.
look for the supporting evidence.
Meticulously look for it. Signs of informed money accumulation, significant divergences between price and indicators, well-defined price structures providing potential support or resistance. It's about reading the whole story the price action is telling, not just the last number.
Price in isolation tells you very little. You need the narrative behind it.
Precisely. Is there evidence of smart money buying? Are there discrepancies between price and indicators suggesting a momentum shift? Is the price action happening within a clear structure? Those are the critical questions.
Okay, principle number 2.
Second, and this is a key strategy we advocate at Accumulation Pro, prioritize those opportunities where you see compelling evidence of accumulation happening while the price is in the lower half of its annual trading range.
Why that specific focus?
This strategic focus can significantly cut your potential downside risk if the trade doesn't immediately pan out, while simultaneously boosting your potential for capturing significant gains when the stock does eventually move up. Low-risk entries with high reward potential, that's always the sweet spot, isn't it?
It absolutely is. You're potentially buying before a major move gets going, limiting downside.
Exactly, strategically positioning yourself.
In the third principle, especially for those higher-priced entries.
Third, and this is vital when considering trades at relatively high price levels, always seek robust confirmation from reliable market breadth indicators. Ask yourself, is this upward move broad? Are lots of stocks participating?
And are the indexes confirming?
And are the key market indexes showing concurrent strength, confirming the bullish environment? Getting clear confirmation across these critical areas can significantly reduce that risk of being the proverbial last buyer right before a potential drop.
It's about not being isolated in a potentially weakening market.
Fundamentally, yes. Before committing capital to high-level breakouts, ensure the broader market supports the move. Strong breadth, index confirmation, they significantly increase the odds the momentum is sustainable, not just an isolated blip ready to reverse.
So ultimately, successfully managing price risk. It really goes beyond just avoiding high prices or chasing low ones, doesn't it?
It absolutely transcends that simplistic view. It demands a holistic, multifaceted perspective.
One that carefully considers the price context within its annual range.
Diligently recognizes the footprints of sophisticated investors through accumulation signals.
Carefully analyzes the market's breadth and overall health.
And accurately gauges the prevailing momentum.
And when you thoughtfully integrate all these different insights into your analysis, you're just far better equipped. Better equipped to sidestep those potential market traps and strategically position yourself for trades that offer a significantly higher probability of long-term success.
Well said.
And for those of you listening who are really serious about refining your trading strategies with these kinds of data-driven insights and significantly enhancing your risk control, we strongly encourage you to explore the resources available over at accumulationpro.com.
Tell us a bit more about that.
Well, you can discover how our cutting-edge trading algorithms, which are specifically designed to track smart money activity and emphasize robust risk management protocols, can really contribute to your long-term trading success. It's about helping you navigate the market's complexities with, hopefully, greater confidence.
So for deeper insights and tools, visit accumulationpro.com. Learn more and take that next step in your trading journey.